Today, we're going to go through a strategy that's produced just under 10% on average every year since the last 30 years. And that is with most years producing a positive return. A very strong strategy, a strategy that has been getting a lot of talk online and elsewhere. And so that is what we'll be talking through today. So let's jump in. Hi, my name is James Corsier and welcome to the Money Paradox podcast. And yes, that is right. We'll be going through the Ray Dalio all-weather strategy, a very powerful strategy. And that is because it has been able to produce a very strong return, just under 10%, over a very long period of time, on average every year. And the key thing here is with a very low volatility. And what I mean by that is very few years have produced a negative return. In fact, it is less than 15% of the years if you look at the last 30 years. This is a strategy that's been back tested for like the last 100 years and it has still produced phenomenal returns. So a strategy where you can get a very high return, just under 10%, while getting that very low volatility, i.e., each year not producing really any one year producing really particularly negative results, is really powerful. Okay, because usually when you get those very high returns, like for example the stock market, that usually comes with that volatility and that risk of getting those really, quite frankly, horrible years, right? Like 2007, 2008, a halving of the market. 2002, 2003, again, half of the market in its value was lost. It dropped by 50%. Crazy, right? And if you were invested in that market at the time, that is going to feel very stressful. You're going to lose a lot of money, and to weather that storm would take some serious resolve. And this strategy is able to still get those strong returns while reducing the volatility, reducing that risk of those negative losses. Now, this is an important caveat, right? This we're talking about in the past. These things have happened in the past. And who knows what's going to happen in the future, okay? This, things might go up, might go down. Who knows, all right? I can't say for certain what's going to happen in the past. But what I can say is this strategy, when it has been back tested in the past, in the last 30 years, 100 years, it has still done very, very well, okay? So with that in mind, let's jump in, okay? So before I kind of go through this strategy, what I want to do is I want to first kind of explain who this Ray Dalio guy is, where it's all come from, and why this thing is so powerful and why I've decided to talk about it. Well, firstly, the reason why I like to talk about it is because it is a strategy that I often advocate. I think it is very powerful. And that is because if you're getting started on the road to investing, you're not sure, you're not hugely experienced, you're not confident about where we are in the market and what types of assets are going to go up or down in the future. Okay, this is powerful because it's what we call an evergreen approach. It means that regardless of what situation we are in the economy, the market, what politics is playing out, this strategy should still do well over the medium to long term. And that is because it is a diversified portfolio. That just means you've got lots of different things put together in the right kind of ratios so that when one thing goes down, another thing will go up, ideally. Okay, so that when pulled together, you're not having a situation where everything you own is going down at the same time and you're losing a lot of money. That brings with it a lot of stress. And if you want to then, use that money for something like an emergency, for example, you're having to use that money, use those investments when the value is down, which is not good. Okay. And also, this is a big addition. A lot of people, the kind of classical view around investing is, you invest for kind of like 30, 60 years because you're investing with this big horizon to retire at kind of like 65, 70 years old. Well, I think that's rubbish. Personally, I'm a big fan of early retirement. Becoming financially free, financially secure, financially confident as quickly and as early as possible. And for us to do that, we're talking shorter windows, right? 5, 10 years, 15 years, whatever it is for you. And so if you're investing in something that potentially could get big losses over kind of like the 1 to 5 to 10 years, then that's a big risk for you, right? That might have to put off and delay your ability to become financially free, right? And we don't want that, right? We don't want to wait another 5 years to become financially free. That is not a good idea, okay? And so if we look at the stock market, for example, if you invested all your money in 2007, okay, or a few years before that, and then your ideal time to retire, early retire, or become financially free, and kind of not be reliant on earning money was a few years after the big crash, then you would have to delay when you would kind of early retire, right? So that's not good. We don't want to be in that situation. So that is one of the additional reasons why this is so powerful. Okay, so who is this Ray Dalio guy? Well, in the investing world, he is extremely famous. He's notorious. He's an absolute legend. Within this field of investing, he's what we call a unicorn. And the reason why we call him a unicorn is that, not that he doesn't exist, he does exist. He is a real person. He is not like Santa Claus. And if you did think Santa Claus existed, then I'm sorry to break it to you. But on a serious note, he's considered a unicorn because he's very rare. And what I mean by that is the reality of the investing world is that most people aren't able to beat the market. And what I mean by that is if you take, say, the stock market goes up on average by so many percent a year, right? You take the last 40 years, sorry, it's 14%. Okay. And it's in countless studies done on this, that when you look at all of these professional investors, portfolio managers and so on, that the majority of them, and the vast majority of them, when you look at the performance of the funds that they have managed, right, they are lower than the average return of the stock market. That is insane. What that is basically saying is that you just investing in the stock market, the S&P 500, the top shares in the market in the US, the UK, whatever, right? The market as a whole, you would get more money, you would make more money from the stock market as a whole than you would by investing in these specific funds that someone is like paid to manage and is supposed to be doing it because they know what they're doing. That is insane. What that basically means is it doesn't benefit you from investing in these people. What you're better off investing in is the market in general, right? To not try and beat the system, but just go in with the system, go in with the stock market and invest in the stock market as a whole. Now that might be controversial to some of you and to some people out there, but generally speaking, that really is the case. If you do your research, there are countless studies showing that. And some, express it as literally like a few percent, if not less than 1% of people can truly beat the market. And those people that are beating the market, you look at them in the next 5-10 years, they aren't beating the market. Okay, so I'm not going to talk more about that, but essentially what I'm saying there is most people that work in this industry that are trying to beat the market often don't. Now with Ray Dalio, the reason why he's called a unicorn, he's one of those very few people that is able to consistently beat the market time after time after time. And not only that, but by some really substantial margins. And that is why he's so famous. That is why he's so notorious. And that is why he is the owner of the largest hedge fund in the world. I mean, that's pretty impressive, right? The largest in the world, right? This hedge fund has over 170 billion, that's not million, $billion in it. It is so big that they can't take any more money on. If they took any more money on, then what would happen is they would what you call a market maker. That it would mean that the investments they want to invest in, they can't invest in because they would invest too much money into it, which would affect the price. Think about that. It's so big, they cannot take any more money on. So, people like you and I can't go and invest in these funds that Ray Dalio has. That is insane. That is bonkers. That is another level of investing, right? one of his main, kind of more what you would call his more actively managed fund is what he calls the Pure Alpha Fund. And this fund in 2008, when the market halved, right, 50% drop, this fund went up 9.5%. It went up 9.5% in the year when everything seemed to be falling apart. Last year, it went up 45%. That is such a huge growth in just 1 year. So this guy, let me put it this way, this guy knows what he's talking about, okay? If anybody knows what he's talking about in the area of investing, this guy really does. Now, this is not the only person I follow. There's a lot of people out there that I highly respect. Less than I would like, unfortunately. That I don't think there's a huge amount of people that really are really experienced and know what they're talking about in the area of investing and are ethically, respectfully sharing honest and true information on a consistent basis. But Ray Dalio is one of those people. Now, I think his wealth, his total wealth, right, is over $18 billion. Just think how much money that is. If you put that all in a room, I don't even think it would fit in a room. That is ridiculous. Anyway, so this guy is big, right? And I just want to kind of really make that point, right? This isn't just some random dude that kind of came up with this strategy and I heard about it and I'm telling you about it. I didn't hear about it down the pub, right? This is a strategy that has come from someone who really knows what he's talking about. I've used it, and a lot of people that I know have used it and have benefited greatly. Okay, so this comes from experience, my own experience, and from somebody who knows what he's talking about. Okay. Last thing I want to say as well around this subject is Ray Dalio accurately predicted the 2008 crisis. So not only is he able to obtain very strong returns higher than the market in general, but when we have those periods of downturns, he sees those coming. He understands why those exist. Doesn't catch them all, but he understands the concept of where these downturns, where these crashes come from, and so takes that into account in how he invests and the kinds of structures of investments are set up. Okay, right. So let's go on to the strategy itself. Okay, so like I said, over the last 30 years, it produced a return of just under 10%. Now, it's not like 30, 50% returns. It's not like crazy abnormal returns, right? Just under 10%. But that's still a very strong return. If you're getting started and you're investing in a way that's pretty reliable, it's fairly it's not having to get you to actively check on everything and see what kind of the market's doing and maybe change because of what the market's doing, right? It's not having you do that. It's not requiring you to constantly check up on all these different market situations and all the different assets and why they're performing as they are. It's not going to do that. It's a standard, strict portfolio. It has some rules. You follow the rules. That's it. Okay, and it still produces just under 10%. That is very close to what the stock market return is, right? Which is extremely volatile, extremely risky, but you're still getting most of the returns. Pretty cool, right? The next thing is, like I said before, 85% of the years over the last 30 years, 85% of those years, you got a positive return, right? So very few years did you actually get a negative. You did get negative returns sometimes, but it's very few, right? So you're not having that constant palpitations of, oh my God, my returns are so crazily low, right? You're not getting that. And then of those negative years, just that 15% of years, the average loss was less than 2%. Okay, so very few years was a loss, and of those years, the average loss was less than 2%. So like nothing. Okay, so what I'm trying to say here is you're still getting those really high returns, just under 10%, but you're not getting those big drops. And for a lot of people, that's a really important point, because you may well say, oh, it's not a big deal if the crash happens. Okay, I know I can weather it, and get through to when my investment does well again. But when that comes, when something you invest in drops by such a huge amount of money, emotionally, the stress around that, around like the impact on that and what you do and so on, you're constantly thinking about it, like for a lot of people, that's just not worth it, especially if investing is not your forte. It's not something you want to focus on. It's just something that you know is important as part of our everyday lives, of our everyday financial setup and stability. Okay. It also beat the classic, what we call 60-40. So 60-40 is this whole concept around, you start with, say, for example, 60% in the stock market, 40% in bonds, and then over time, as you get closer to retirement, you reduce your amount of money in equity, right, in the stock market, and you increase the amount of money that you have in bonds, government bonds, which is seen as safer, so that as you come close to retirement, more of your money is in a safer asset. Traditionally done by like pensions, like pension funds and so on. Been talked about for many years, and quite notorious as an investment approach. Has also beat that, so very powerful. All right, so that is the all-weather strategy just generally in terms of the big numbers around why it's so good, why it gets such really strong returns, and how little volatility you get. So powerful, right? Impressed? So why does this happen? So the main reason is that the all-weather strategy effectively asks you to invest in a number of different things in a set ratio. So why are we investing in a number of different things? We're doing that because some things go up in certain situations and other things go up in other situations. So for example, at the moment, the US economy is doing fairly well. It has done for quite a number of years. The UK economy is doing not so well with Brexit. Other countries like China had been doing very well for the last few years. Is showing some signs of concern because of the trade war with the US. There's all these politics, all these economic situations are going on. Now, some economies are doing well, others are doing badly, and over time that changes, right? So, we're not all full-time economists, news followers, political enthusiasts, right? So to follow that and understand it and understand how that impacts all the different assets is it's complex, it's long, it can be boring for a lot of people, right? And quite frankly, we don't want to spend a lot of our time doing that. And also, even if we do, we don't necessarily have the confidence that we know that which assets are going to do well or badly in the future as a result of all of that, okay? So this investment approach is effectively looking at a way to deal with the fact that all of these situations are changing, but we don't want our money that we're investing to suddenly go down in certain situations, right? In the short term, but also in the long term. Okay? Now, at this point, I want to give you a quick story about how this strategy came to be. It came to be because Ray Dalio is getting to his later years. In fact, he's very old, and he's looking at his, his legacy. So part of that is he's got all this money, huge amount of money, and he wants to make sure that his family are taken care of and their family are taken care of. Now, he is a very good investor. So he knows that while he's alive, he can make sure he invests his money well, invests his family money well, so that they've always got good money to be able to live a good life. But then he was like, when I die, then what? Well, I'm not going to be able to invest the money. So what do? Do I give the money to somebody else to invest? Well, I don't know. Don't really trust anybody else. Like, most people suck at investing. Most people can't reliably do it. And I'm not alive to make sure that's a good person, it's the right person, that they're doing the right things with the money. It's a lot of uncertainty, a lot of risk there. And, maybe I can find someone good now, but then what about when that person dies or stops wanting to invest? Then what? Who does he pass it on to, right? There's only so long that I can control a safe place for the investments for my family. So he said, what if I could come up with an investment strategy that, over the medium to long term, I know it's going to do well. Okay, it might have some like bad patches, but generally speaking, in the medium to long term, it's always going to do well. Okay, well then I can invest that money in that way and just say, right, it needs to follow that system regardless, and tell somebody to invest in that specific way. You can't make any decisions, you just have to do it on that method forever. Well then, if I'm able to come up with that works, all I need to do is put that in place, and then I know that money is going to reliably go up in value and not have any major shocks forever, effectively. So then I know that money is safe for my family after I die. Pretty good idea, right? Now this guy is famous for thinking outside the box, asking the questions that people don't necessarily ask. When people are just saying, what's tomorrow? How do we move forward? How do we increase by 5%? He's saying, well, actually, is this the right business? Is this the right way we should be doing it? Everybody's moving right. Why are they moving right? Should we move left? Should we be moving any at all, right? He asks those questions that people don't often think, right? So a very, very intelligent man and a very unique way of thinking. So he came up with this kind of exam question, and then in not too long, he came up with a solution. He tried a few different things, came up with an idea that he thought would be fairly powerful. And then what did he do? He back-tested it. He tried it for the last 40 years, 100 years and so on, and realized that it was producing very strong returns. And not only that, but it was not getting those big drops, and most years were positive. Okay, so he tested it to kind of really understand why, and develop real confidence in it. So he set this up, got a lot of his family invested in it, and it was great. He started to talk to people about it. Everybody got really interested. That's a really great idea. Can I invest in that? Can I do it? Can you put some money in for me? I said, yeah, sure. So he started as a very informal thing, fairly small. Started to build and build and build to the point where it became one of Bridgewater's main investment vehicles. Bridgewater is the company that he owns, the investment company he owns, and became a big part of one of the things they offered, right? It became huge because it was so popular, such a good idea, to the point where even that fund became so big that it became very difficult to invest in as well. So that's the backstory, right? A really clever idea of solving a real problem for himself that ended up to kind of escalate. Now, this strategy that I'm going to tell you later is a kind of a simplified version. It's a simplified version so that most people with a bit of knowledge can apply it. Okay, what he does is a little bit more complicated. He does various other kind of like mechanisms and steps and so on that for a layman like you and me, then it is a lot more simple to implement. Okay, and easier to implement. Okay, so all right, with further ado. So the way he explains it is he talks about that the market is there's all these different changes, these variables that's going on that affects various assets. And really, when you nut it down, there's two fundamental things that can affect assets. One is the economy. So if the economy is doing well, some assets do well. If the economy is doing bad, other assets do well. If you look at inflation is increasing, then some assets do well. And if inflation is decreasing, other assets do well. Okay? So the idea is that if you invest in a number of different things that sit within each of these four blocks, right? Economy doing well, economy doing badly, inflation going up, inflation going down. Okay? Invest in all four of these things, then regardless of which environment's playing out, you've always got something that is doing well, right? So even if something is doing badly, something else is doing well, okay? Something's doing badly, something else is doing well. That's the idea, okay? So let's give you some examples, right? So if the economy is doing well, right? If you take the stock market generally is doing well because the economy is doing well, there's more consumption, more demand, right? More money flowing through the system. That means then companies are becoming more successful, the value of the stock market's going up, and therefore, if you've invested in that stock market, then your money is going up in value. Okay, Another one is commodities. So commodities is just like raw materials. Now, actually, if you want to know more about all of what I'm talking about here, all different types of assets and the variables that can make them go up and down, check out the previous video. Talk about that in a lot more detail. I think you'll find that really interesting. But I'll talk about it through just a little bit, just so you understand it from the Ray Dalio strategy point of view. Okay, so if the economy is doing well, stock market goes up. Okay, generally. Also, commodities go up, because if consumption and demand, the economy is all very, very successful and growing, and there's a lot of confidence. Well, then what do these companies need to produce all of this stuff? Well, they need raw materials. They need wood and iron and copper and gold and platinum and oil. They need all this stuff to make all the things that the economy is wanting. So the value of the commodities go up because the demand is going up, right? And then last one, corporate bonds. So corporate bonds is, instead of buying a piece of a company, you might want to loan some money to a company, right? Because they want to invest, right? So the value of those bonds are going to go up. You're going to get a higher return because they've got more to do with those bonds. They've got more demand for money to go out and invest, to spend that money to build the company, because they're getting really strong returns. So they're more likely to give you a higher returns, and so the corporate bonds are going to go up in value. Okay, now decreasing economy. If the economy is going down, well, okay. So think about it. If the economy is doing rubbish, and the stock market is doing awfully, credit's really hard to access, everything's really uncertain, everybody's really worried about what's going on. Well, if you've got some money, where are you going to put that money? You're probably going to put it into something safe, right? So you either keep it in cash, or you're going to put it in something, say, like government bonds. You're going to lend it to a very reliable government. So if you lend it to the UK, the US, for example, they are big, strong, reliable economies that, extremely unlikely those governments are going to not pay you back. And as a result, there's going to be more demand for lending to those types of governments. And so the value of those types of bonds, right, those loans, are going to go up in value, effectively. Okay? And the second one is long-term corporate bonds. All that means is, things that over a longer period of time, more there's like longer of an opportunity for those companies to kind of do well and get back into shape, especially on those really long, like old, mature companies that stand the test of time through a number of different corrections in the stock market. Okay, so now let's look at inflation. Okay, so inflation, if the inflation is going up, like what is inflation? Inflation is the slow devaluation of our money, right? So if I have £100, okay, and inflation is say 5%, then what that means is in a year's time, my money is going to be worth 5% less. So today it's worth £100, in a year's time it's going to be worth £95, right? So what happens is, if inflation is high, over time, our money is going to go down in value more quickly. So cash is going to be worse to hold. Okay? So if inflation is declining, it's lowering, then cash is better. Okay? Then you want to stay in cash, because the value of cash is diminishing less quickly compared to other things. Okay? So if inflation is going up, cash is going down quickly, so we want to move it into something else that's not cash, like gold. Okay, so we want to move it into something that is not cash, so that cash devalues, gold stays the same or up relative to cash, so that the gold becomes more valuable in terms of cash, in terms of money, right? So then you buy gold, and then a year later it's gone up in value relative to the money, and then you buy back the money at a higher price. You've effectively made money through the increase in inflation and the decrease in the value of money. Don't worry if some of this doesn't make sense. It's absolutely fine. I'm just giving you some examples as to why this thing works. Effectively, it's just that you're investing in different things that do well or do badly in different environments. Okay. Just quickly, if you're enjoying this, video, please do like it. Send me some comments. Let me know what you're enjoying, what you'd like to see in future videos. What is it in particular you'd like to see be covered off or in more detail? Any advice, feedback, content for future videos, let me know. We'd love to hear that. And if you think there's anybody that you know that would appreciate this video, that would benefit from this video, please do share it with them. All right. Okay. So if inflation goes up, say, for example, commodities. So if you think about inflation, inflation is just when the things that you're having to buy with your money becomes more expensive. Well, commodities is one of those things. So if inflation is going up, it means that commodities, generally speaking, have gone up. Property has gone up, generally speaking, right? So if you think about, there's like indexes for inflation, RPI or CPI. RPI is a collection of goods or services that we buy. Property, various products, commodities, these are the kind of things. So if these things are going up in value, inflation is going up in value. Okay? All right. So essentially what I'm saying is there's different things that do well or badly in different environments. So what do we want to do? We want to own a number of these things. Okay? So what are those things? Well, this particular strategy, there's various different what we call portfolio investment strategies. Okay, there's many different types, but this one only has essentially 4 different types of assets that we're investing in. Right, it's different ones that work in different ways, but this one in particular has 4, and those 4 are: 1, stocks, stock market. Okay, number 2, government bonds. So government bonds are essentially where you are lending money to a government. A bond is just a loan essentially, and it's to the government, right? You don't necessarily need to do it physically to the government, you do it through an intermediary. We'll cover off how you do it in practice later in future videos, but that's essentially what it is. Thirdly, commodities. So commodities are like oil, grain, metals and stuff, raw materials that companies need to produce things. And then lastly, gold. Okay, gold is like a commodity, but it's more like a store of wealth, an alternative store of wealth to cash, to currency. All right. So we made it clear that we need to invest in a number of different things. So, and then we talked about and why. Then we're talking about what are those things. Well, it's these 4 things that I've just covered: gold, government bonds, commodities, and stock market, government bonds, commodities, and gold. Those 4 things. Okay. And the reason it's those 4 things is because that's like the simplest way to cover off each of these 4 areas sufficiently so that you're covering off all the different environments with the kind of least amount of things in the most reliable way. That is essentially why it's those 4. Well, so we know the 4, but then the next question is, well, in what ratio? Because, you could go off and you say, well, I'm going to of my, say, £1,000 worth of money that I want to invest in this approach, I'm going to put £250 in the stock market, £250 in government bonds, £250 in commodities, and £250 in gold. Okay, so that's one way of doing it. Now, the danger with that, though, is that if in one situation the stock market goes down by 50%, but government bonds go up by 10%, okay, and you've got the same amount of each, even though one of your things have gone up and one of your things have gone down, overall, you're still massively down because your shares have gone down by 50%, but your government bonds have gone up by 10%. Does that make sense? And that is because each type of asset has a different level of volatility. And volatility just means that level of movement. The stock market moves a lot, right? Some years it goes down by 50%. Other years it can go up by 10, 15, 20%, right? It has a lot of movement there. Other things like government bonds has less movement. It's more shallow in how it moves. It can still move quite aggressively, but a lot less than the stock market in general. Okay. The other thing is it's impacted less. Some things are impacted less or more by certain situations. So if the economy is doing badly, the stock market can drop considerably, but the government bonds may just go up by a small amount. Okay, so that's the example of government bonds and the stock market. What about gold? Gold's even more volatile than the stock market. It can go up and down huge amounts, in days, literally just days. Okay, so even more volatile than the stock market. And the same with commodities. Commodities, there's a huge amount of variables that can impact them. You have huge shocks in the prices of commodities, which can dramatically change the prices of them. And so as a result of that, we need to take that into account. And the way we do that is we change how much we invest in each of these things. So, you want to hear what the ratio is? What that split is? Okay, so moment of truth. So, the thing that has the least volatility, the least movement, you want to invest the most in that. And that's because if a certain situation plays out, you need more of that because it's going to go up or down less than something else. So government bonds is the thing you want to be investing the most in. And this is quite a lot more than you may think. 55% in government bonds. Now there's a slight shift in this because it's 55%, but it's invested in two different types. And we call these long-term and intermediate bonds. Now, long-term just means bonds that are invested are a loan of a very long period of time, usually about over 15 years. Yeah. So that means if you take that bond, it's like saying you're lending money to the government, and you say, government, you give me the money back, say in 15 years' time, plus a certain level of interest each year. Okay. So you're committing to lending that money over a very long period of time. And you're committing to a certain level of interest over that long period of time. Now, you don't necessarily need to hold it for 15 years, but that thing that you're buying has a commitment with the government for a very long period of time. Right? That's the key. So the interest rates are kind of stuck for a very long period of time. Now, I won't go into all the details around that and why that impacts it, but essentially, the majority, 40% of the 55%, is in long-term government bonds, over 15 years. The other 15% is what we call intermediate, which just means shorter, not really short, but less than long-term, so 7 to 10 years. Okay, so a shorter time period that you're lending to the government for. Okay, all right, so that's bonds. The next, the next kind of more volatile thing gets 30%. This is the stock market. 30% of what you're investing in goes into the stock market. All right, and this is essentially the stock market as a whole. Now you can decide whether that's the US stock market, the UK, the global stock market, and we'll go into exactly how you do it and what types of things you can think about. But effectively, it's the stock market as a whole. Okay, so companies effectively. All right, so that's the stock market, 30%. And but you're doing investing less in that relative to the government bonds because that is more volatile than government bonds. All right, and then you have gold and commodities. Now, gold and commodities are the most volatile, so you need to invest less in it because it will vary more. And that is the remaining 15% split equally. 7.5% in gold, 7.5% in commodities. And that is your 100%. 40% in long-term bonds, 15% in intermediate bonds, 30% in stock market, 7.5% in gold, and 7.5% in commodities, making up 100% of your pie. Yeah? Makes sense? Good. So I've just quoted you a load of different things, a load of different percentages of stuff. So you may well be thinking, well, how the hell do I actually do this? How do I actually set this up, right? Well, the first thing you need to kind of appreciate is like, what does it mean by each of these things? Okay, what's a good way of doing it? Well, ultimately this is a decision you need to make in terms of what exactly you specifically want to invest in. Okay, that is your investment decision. This is just general investment, education, information, right? But I can give you some illustrations and some kind of analogies around this. So firstly, long-term bonds. So it's got to be a government bond. Well, you want to be doing it in a reliable government. So the UK, the US, developed economies like certain parts of Europe. governments that are reliably going to pay back that money. Okay? So you may want to just do it in the US, the UK, or you might want to do it in a number of different ones collectively. Okay? Then you want to split it between long-term and those intermediate ones. So you can do it by looking for funds. Funds are simply, a fund is a company that has set up effectively a bucket, and they put in a load of different things that is exactly what you want. So they've gone out and got a load of government bonds with reliable governments, maybe one particular country, and they made sure the term of those loans were over 15 years. Well, that's what you want, effectively, right? So you want to be doing with the right ratio and making sure the term of those meets what Ray Dalio is talking about here, over 15 years for long-term bonds, 7 to 10 for intermediate. Next one, stock market. Stock market. So effectively, you don't want to be investing in specific shares, because then you've got the risk of those particular companies going down or up differently to the rest of the stock market. So you could invest in, say, the US stock market. For example, the S&P 500, the top 500 US listed companies. You can invest in the FTSE 100, the top 100 companies listed in the UK. You can invest in a fund that invests in many different indexes or companies in developed economies all over the world. That is another alternative. You can invest in Europe, many different ways you could do it, right? And you just be careful that you are investing in the right thing, that it is definitely what it's saying is, and the cost of those funds are lowest possible, right? Because the key thing here is that a lot of these funds that you would be investing in to do this charge different amounts, some more, some less than others. Some can charge 10, 100 times more than others, right? And there's many different costs involved in the fund. Some can be very hidden, so you need to be careful about that. Another thing is around whether it's active or managed, or sorry, active or passive. A passive fund is essentially a fund that just follows some rules. And because it's just following some rules, just like this, then it's very cheap, because you're not having to pay some very expensive, experienced person to decide to make some decisions on it. They're just following some rules. So it's much cheaper for them to manage it, and therefore they don't charge you as much. An actively managed fund is where they're deciding, oh, I think that's going to do well, I think that's going to do well, so I'm going to put the money in there. So you have to pay more for that facility. Remember what I said earlier? That most investment funds, actively managed funds, do not beat the market. They actually are worse than the market. And then you have the fees on top. So I would personally stay away from active funds and stick to those passive funds. Okay. And then for gold and commodities, again, so what you can do is you can just buy a fund that owns that gold, or buy a fund that owns a number of commodities. Make sense? Good. I don't mean you can go out and actually just buy the gold. You can do if you want, but then that will be cost. You've got to store the gold. It's all very complex. Okay. So effectively, you're buying each of these things in a set ratio, and you're making sure you are buying the right things, reliable versions of those things. You can use funds to do that, and then you can use an intermediary to be able to do that, like Fidelity or Interactive Investor or Hargreaves Lansdown. These are all very famous companies. They're effectively intermediaries that can facilitate you buying these things, right? Now, you've got to be careful. You've got to do your research. Which one do you want to? Which company you're going to go with? That you're buying the right things. Be careful, and if you're unsure, get financial advice. Get professional financial advice, and go ask them. Okay, good. So there you have it. That is the Ray Dalio all-weather strategy. So to summarize, what Ray Dalio has kind of covered here is effectively 5 different types of investments that do well or badly in different economic environments, that when pulled together, on the whole, do well in the medium to long term, regardless of the economic situation. So that in any one year, you're not losing big amounts of money, you're not getting that stress of your value of your money going up and down in huge amounts of time, so that if you need access to money at short notice, that isn't an issue. You're not going to suddenly be hit with a huge drop in value. You're not going to get stressed out by it. And you're still getting strong returns. Over the last 40 years, 30 years, it received just under a 10% return. Now, will that get a similar returns in the future? Who knows? But it's been backtested over a huge time periods and has done very well. So with that, please invest responsibly. Make sure you're confident in your decisions. You get professional financial advice where needed before you make any decisions. I hope this has been valuable. If you have found it valuable, please like the video. Please comment. Let me know what you've enjoyed, what you found useful. Let me know what you thought were the key takeaways. If you would like to see further content going forward on this particular topic, on other topics, please let me know, direct message me or comment, and I would love to cover those areas. I want to make sure this content is as valuable and as useful for you because you're the people watching it, and that is why I am doing these videos. If there is anyone that you think would benefit from checking out these videos, please share it with them. Please spread the word. That would really make my day. Okay. With that note, have a great rest of the day, and that's it. Bye from now. Bye-bye.